Terrified a sudden layoff will destroy your 740 credit score? You do not have an employment problem. You are entering the 90-day utilization trap. Here is how to disarm it. The layoff call comes Wednesday at 11 a.m. By Friday, your score has not moved a single point. By month 3, it is down 90. That gap between the day you lose the job and the day your credit collapses is the entire game, and most people fix the wrong problem in the wrong order. This is Optimized Credit, where we teach how credit actually works. This video walks the exact 5-call sequence that keeps your file clean while you find the next job. Start with what your score is actually tracking, because the bureaus do not know you got laid off. Your credit report has no income field, no employment field, no tab where HR notifies anyone that your paychecks just stopped. FICO does not know. VantageScore does not know. Hold everything else constant, and an unemployed credit profile looks identical to an employed one. The damage that shows up later comes from 3 transmission paths, and almost all of them are preventable with phone calls. The first path is missed payments. A single 30-day late on a clean high 700s file drops the score 60 to 110 points and stays on the report for 7 years under federal law. Not 7 months, 7 years. That one mark, made in a panic during the first cycle, follows you into your next mortgage refinance. The second path is utilization, and this is where the 90-day trap actually lives. Picture $30,000 in revolving limits and $3,000 in reported balances. You are sitting at 10%. Lose the income, charge $10,000 on essentials over 2 billing cycles, and your reported utilization jumps to 43. The score drops before you ever miss a payment. People watch their balances. Almost nobody watches the date the issuer reports those balances to the bureaus. The third path is panic. New credit applications, closing long tenure cards, premature 401k withdrawals that detonate a tax bill the following April and force more borrowing to cover it. Your credit monitoring app will start suggesting these moves in week 2. Ignore the app. The first 90 days are not about rebuilding anything. They are about not creating permanent damage that takes 7 years to undo. Now the playbook. 5 steps in this order. Order matters because the worst downside debts get triaged first. Step 1 is housing. On day 1 or day 2, call your mortgage servicer and ask about hardship forbearance. Fannie Mae, Freddie Mac, FHA, VA, and USDA all have federal forbearance programs for documented financial hardship. Here is the secret. Under federal mortgage servicing rules, an account that is current at the moment forbearance starts must continue to be reported as current for the entire forbearance period. It does not show up as a delinquent trade line. You protect your cash and you protect your score in the same call. If you rent, call the landlord before the next rent date. A written payment plan is almost always cheaper for them than evicting and releasing. Step 2 is credit cards, and this is the fastest moving lever in the entire algorithm. Revolving utilization controls roughly 30% of your FICO score, and it is completely unforgiving during unemployment. Pay each card down before its statement closing date, not its due date. The statement balance is the exact dollar amount the issuer reports to the bureaus. Pay on the due date and you have already missed the reporting cycle. The high balance is locked in for another 30 days. Then call every issuer where you carry a balance and ask about their hardship program. Chase, Citi, Bank of America, Wells Fargo, Capital One, Amex, and Discover all have internal hardship departments. They do not advertise these programs, but they exist to prevent defaults. The script is one sentence. You lost your job. Here is the date. What hardship options are available? Get the terms in writing. If you want a free, personalized 90-day layoff plan built from your actual 3-bureau credit report, head to optimizecredit.net. Now for the critical detail. Step 3 is federal student loans, and federal loans have a feature no other consumer debt has. Your monthly payment legally drops to zero when your income drops to zero. Income-driven repayment plans calculate the bill from adjusted gross income and family size. With no earned income, the formula spits out $0, and a $0 IDR payment counts as on time. The loan does not go delinquent. The credit report continues to show the account as current. Log in to studentaid.gov, select Manage Loans, and recertify with your most recent paycheck or unemployment award letter. Processing takes 5 to 14 days. If you are stuck between paychecks and the benefit letter, call the servicer and ask for a 60-day administrative forbearance to bridge the gap. Approved before a missed payment, it does zero damage to your file. Step 4 is the auto loan. A car is a secured debt, which means the lender can repossess. In some states, that process begins at 30 days past due. But auto lenders do not actually want your car, they want the interest. Most major auto lenders, Ally, Capital One Auto, Toyota Financial, Ford Credit, the credit unions will approve a 30 to 90-day payment deferral on a single phone call when you document the layoff. Those payments do not disappear. They capitalize and move to the back of the loan. During the deferral, the account is reported as current under hardship, not as missed. 3 rules. Call before missing a payment, never after. Get the deferral terms in writing, including the credit reporting language. And do not refinance into a longer-term loan during the unemployment window. The interest cost is almost always higher than the deferral cost, and a new loan stamps a fresh hard inquiry on a file that is already stressed. Step 5 is avoiding the score killer mistakes, because the most permanent damage during a layoff comes from your own panic, not from the banks. Do not apply for new credit. Hard inquiries and new accounts drag your score down precisely when you need it most. Skip the balance transfer offers and the personal loans. Never close your long tenure cards. Closing a card wipes its credit limit from the utilization math and instantly spikes the percentage on every other card you keep open, a 20 to 40 point drop, for free on a move you thought was responsible. Freeze the card in your app. Cut the physical plastic in half. Remove it from browser autofill, but keep the account open so the limit protects your score. Do not pull cash from your 401k before age 59 and a half. The 10% federal penalty plus ordinary income tax usually costs more than the cash you actually receive, and the tax bill lands the following April. The Rule of 55 carves out a narrow exception for workers 55 or older who separate from their employer, but it does not apply to IRAs and does not waive the income tax. A 401k loan is sometimes cheaper, but it typically becomes due in 60 to 90 days if you do not return to that employer. When cash is genuinely tight, follow the triage order from the Consumer Financial Protection Bureau. Housing first, then utilities, then secured debts like the car, then minimum payments on credit cards. Unsecured personal loans and medical debt come strictly last. Medical debt has the longest pre-collection window of any debt class, the strongest negotiation leverage, and recent rule changes have stripped most of its credit reporting weight. Never pay a medical bill if it means missing rent. One edge case breaks the playbook and you need to know about it. If you got laid off while a mortgage application is already in underwriting, the lender will run a verbal verification of employment within about 10 days of closing. A layoff inside that window almost always kills the loan. There are 3 ways out. 1. A non-laid-off co-borrower whose income alone meets the debt-to-income requirement gets the file re-underwritten on that single income. 2. Documented severance plus an executed offer letter from a new employer with the start date before closing can sometimes substitute. FHA and conventional treat this differently, so the loan officer has to walk it through. 3. Pause the closing and reapply once the new job is documented with 1 or 2 pay stubs. What you cannot do is conceal the layoff. Hiding it from the loan officer can constitute mortgage fraud, which is a far worse problem than a delayed closing. Disclose it the same day. Here is the entire crisis week compressed. Call the mortgage servicer or landlord. Pull all 3 credit reports to baseline your utilization. Call each card issuer with a balance and request the hardship program. Log into studentaid.gov and start the IDR recertification. Call the auto lender. 5 phone calls and 1 website login. In that order, in the first 72 hours. A layoff is not a credit event. The next billing cycle is the credit event. The people who watched their scores collapse in the 90 days after a job loss did not lose points because they were unemployed. They lost points because they tried to fix the wrong problem in the wrong order. Housing first, utilization second, federal loans third, auto loan fourth. No panic moves. Run that order and the layoff leaves no trace on your file. Understanding these foundational rules is only step 1. To map out your exact next moves, run a free profile scan and get your 30-day action plan at optimizecredit.net. And make sure to subscribe for more step-by-step credit education.